So welcome everyone, my name is Jordan Wilson. I'm going to be hosting today's revenue recognition webinar series. Before I start on this webinar, what I'd like to do is just come up a little bit around some of the webinar series that we have coming up. So like I said, this is the first part in a three-part series. Today is very much around getting your business ready for IFRS15 as well as ASC606. And then we're doing two follow-up webinars in the series. So one on the 4th of April around the restatement piece, and as well on the one on the 26th of April around the revenue recognition from now going forward. So, like I said, my name is Jordan Wilson. I'm VP for Marketing over at Inoapps. I am joined by a couple of colleagues. In the room with me is Melanie Dawson.
Good morning.
And on the line I have Nigel Yule from Oracle.
Good morning.
Thank you very much, guys. Do you want to just take a brief couple of moments just to introduce yourselves? So today is going to be a panel discussion around some key topics around revenue recognition. So Melanie, may I let you introduce yourself?
Good morning. My name is Melanie Dawson. I am the Principal Consolidation Consultant for Inoapps, but prior to that I have been a Financial Controller in the private sector.
Thank you, Mel. And Mel's here really to give the idea and the point of view from a finance perspective. And Nigel, yourself.
Good morning, everyone. I'm Nigel Yule. I'm a Senior Director in EPM, Product Marketing at Oracle. My background has been EPM for the last 20 years or so.
Wonderful. Thank you, Nigel. And I'll let Nigel plug his blog at some stage, but Nigel's written a number of a series of blogs around this particular revenue recognition topic, so Nigel's an excellent person to have on board today. Wonderful. So a little bit of housekeeping. On the right-hand side, there is the window which is for the GoToWebinar. If you have any questions, please do highlight them there. If we get time at the end, what we will do is we'll go through them. But if not, what we'll do is we'll collate those and send those around. And this is going to be recorded as well, so we will share that with you afterwards. So I'm just going to take a couple of minutes because I'm conscious that really we're here to talk around the topic of what is revenue recognition. But I just wanted to set the scene from an Inoapps perspective and understand and help explain why we as an organization are hosting this webinar series today. So Inoapps as an organization is a platinum partner. We're completely specialized in Oracle technologies. You can see from the timeline along the bottom here, we've been working with Oracle technologies for over 11 years, and we have a real pedigree around that key area. In the middle there, you'll see there's a map. We have a full global reach, so we've got 4 offices in the UK. We're also based out of Houston, Texas in the US. And we've got some offices over in the east in Kuala Lumpur, Singapore, and Dubai. And that offers us the ability to offer a true 24/7 service to our customers, not only from a support and maintenance perspective, but also from a delivery capability. As an organization, we use a lot of Oracle's cloud technologies, so we do evangelize these technologies, but we also use them to assist our business and to strive and work in the industry that we work in to move the business forward. So the final point on Inoapps before I move into the actual topic is on the bottom right-hand side there. You'll see that we won a recent award, something that we're extremely proud of. We won Global SaaS Transformation Partner of the Year. We picked it up at Open World. It's a very, very big win for us. It's one not only Oracle recognized, but it was actually IDC which picked us from the majority of all the other partners out there. So it's something that we're really proud of. And I think as an organization who's ever looking to move to the cloud or even talk around revenue recognition, it definitely is a badge of honor to give you a safe pair of hands. So enough about Inoapps. It's not about that. Let's really crack on. So what are we going to cover today? We're going to, like I said, it's going to be a panel discussion. I'm going to be covering off the following topics. Very much a case of I'm going to be asking Melanie and Nigel really for their input around a couple of areas and see if we can gain some information. So covering off some of the basics, then move into, well, who's affected by these guidelines, and then really around, well, what's changing, what businesses need to do, what are the challenges, and really what you should be doing to prepare. And then right at the end, we're just going to kind of do a brief wrap up, and we're going to move into, well, what's coming next in the series. So that leads me on quite nicely to my first question, which is it's aimed at Mel. So Mel, could you please just give us a brief introduction to the IFRS 15 and ASC 606 guidelines and what it means to businesses.
Yes, Jordan. IFRS15, or known also as the ASC606, is promoted jointly by the IASB and the FASB, providing guidance on accounting for revenue from contracts with customers. It specifies how and when to recognise revenue. So it depicts the transfer of goods or services to customers in an amount that reflects the consideration which an entity would expect to be entitled to in exchange for those services or goods. And there's 5 key principles or 5 steps to this model, revenue model. And the first one is to identify the contracts with the customer, then identify the individual performance obligations. From there, you would need to determine the transaction price. From there, allocate the transaction price across the length of the contract, and then recognise revenue as the performance obligations are fulfilled.
Wonderful, thanks, Mel. So from that perspective, what do you see in your mind is the impact of this new legislation and the guidelines?
Well, to be fair, it's going to result in substantial changes to the timing and measurement of revenue recognitions and introduces significantly revised disclosure requirements.
Wonderful, thank you. I just wanted to pick up on a couple of points there. So when you were going through those 5 core principles, there's a couple of terminologies that you mentioned. Do you think you could just explain performance obligations as well as the transaction price?
Yes, sure. The performance obligations is a good or a service that is to be delivered in terms of a contract with a customer that qualifies as a performance obligation.
Okay.
The transaction price is to be paid is that's stipulated within the contract.
Right, so I guess from this perspective, it's very much a case of, these are the key points around the legislation that people need to work and focus on.
Correct.
That's wonderful. So, Nigel, Mel's gone through what are the key principles, but I know on your blog you had an excellent example as to, from a business perspective, what does that actually mean to the business? So do you think you could just simply explain what that example was?
Yeah, sure. Absolutely. So this example, it's sort of simple, but it's not simple because it does bring in both the aspects that Mel's been talking about. That is the timing of the delivery of the obligation, but also how you deal with the price. So in this case, we're looking at a computer system, and we've agreed an overall price of $1,000. But in fact, the list price, if you sold these items separately, because there are 3 items, the computer, the software, and the printer, if you sold these items standalone, then the total price will be £1,200. So $1,200, sorry. So we're selling this at a discounted price. We have to reflect that discounted price against each of the individual obligations. So you can see in point 3 here, we've done a calculation and calculated, because we've made a discount, what would the discounted value of each of the items be? But in fact, we're not going to be able to deliver all of the items at the same time. So in fact, if you look at point 5, what it said is, we deliver the laptop and the software in June, and we can then recognize the discounted value of those 2 items, $833.33, and then when we deliver the printer later in July, we can then recognize the final part of the value of the overall value of $1,000, the final part, $166.67. So what you can see here is 2 aspects. One is, we have to separate out the price, the discounted prices, because we're delivering things at different points, and then we only recognize the discounted price for each of the items we deliver at the point that we deliver them. So really, this is the aspect of the pricing's correct and the point at which we recognize is correct. And as you say, Jordan, in my blog I cover this, and I cover a number of other points, and you can find that if you look on LinkedIn under my name, Nigel Yule, or there's a 9 series of items on the blog, so 9 series of articles around this subject.
Wonderful, thanks, Nigel. I think that example really brings in the key bits that Mel was saying around the key principles, but also brings it into a kind of real-world, simple example. So thank you very much for that. So Nigel, keeping with yourself then, so from your perspective, obviously you work for Oracle, big vendor, you see a lot of businesses and deal with a lot of organizations. Who in your mind do you feel is most affected by these guidelines?
Yeah, I mean, you can see some of the industries there, and I'll give you a classic example that we're all familiar with day to day. We all buy mobile phones, and typically we'll buy that mobile phone under a contract, and that contract would include the hardware, the phone itself, and then a service, obviously our connection over a period of time. And so we've bundled together a product and a service. We're delivering that product, that product and service over a period of time, and therefore the way in which the revenue for that service is recognized has to reflect a couple of things. The chances are the phone is discounted because it's being provided as part of the service, so we need to take that into account, and we need to take into account the fact that we're providing that over a...
Oh, Nigel, I think we may have just lost Nigel there. No. Okay. So I think what Nigel was going to say there effectively is that you need to take into account the different aspects of a contract when you take your mobile phone out. Whilst we wait for Nigel to pop back in, Melanie, from your perspective, then obviously Nigel was coming up with a great example, but also around any of these industries. Obviously, you work with finance. You've been part of a big finance team, ex-financial controller. What do you see? In addition to what Nigel was saying around these particular topics?
I mean, as Nigel was saying, is to be honest, this standard has the most profound effect on the telecoms industry. However, it's really going to affect anyone with a contract that spreads over a period of time, has certain obligations to deliver, are going to be affected by this. I mean, also it is worth noting that companies that are in the public sector are going to need to adopt these standards sooner than those companies in the private sector.
Right, that's very interesting, yeah. So, okay, wonderful. So what I'd like to do then, if we move on to the next one then, so really it's around, what is changing and how should companies recognise the revenue. So I was going to ask Nigel to ask for a potential case study here, but I know whilst Nigel is just kindly dialing back in, Mel, from a finance perspective, what do you think is changing and how the business need to do that?
Well, it's really, as we've said, is, how companies are going to recognise their revenue going forward as to how they have been recognised in the previous. So they're going to have to look at the allocation of the transaction price and allocate that to in line with their performance obligations. There is obviously changing mindset throughout the whole company, and again getting a full under these regulations. So what happens if the transaction price changes midway through a contract? What do they do then? Believe it or not, they've then got to reallocate that revenue again retrospectively across the whole period of that contract.
And from your experience of being a financial controller, can you understand the impact and effort that's involved?
Oh, it's trying to keep track of it all and then working out the reallocation of it. I'm glad I'm not in the finance department anymore.
Yeah, and I'm sure everyone who's kind of listening in to this session today can probably relate to what Mel's been saying here around from a finance perspective. We still don't have Nigel yet, so we'll
No, you do actually.
Oh, Nigel, apologies.
I'm back. Yes, I'm sorry. Apologies. I'm obviously having a little technical problem here. You wanted me to talk about case study here. So a classic example of where an organisation might have an issue is let's say, for instance, you're a supplier of electrical products, white goods products, and so on, and you also sell a maintenance contract. That's a situation where you deliver the product, you can recognise the revenue associated with the product, but you have an obligation over a period of time to deliver maintenance or service for that product, and that aspect of the revenue needs to be recognised when the obligation is delivered. So you can't take the revenue for all of the service up front. You need to take that over a period of time, and you have to have a policy as to when you do that. So it might be at the beginning of the year, say, a 3-year contract at the beginning of each year, or maybe at the end of each year. But you need a policy, and to state that policy as to how you do that.
Yeah, and I imagine from a restatement piece, actually, that could genuinely change the numbers that you already had from a couple of years ago.
Absolutely, and that's one of the things that we went through a very, very similar process a number of years ago when we moved from local GAAP to IFRS, because that significantly changed the numbers within the company's accounts. And one of the things that working with companies as I did through that period, one of the things that companies did was go back and make restatements of prior years so that stakeholders could understand the impact that the change in accounting practice would have. And I think we're in a similar situation here. What we don't want to, what organisations don't want to do is suddenly have a huge change in their accounts at the beginning of the requirement to report to meet this standard. They really need to be looking at how are we going back and restating their accounts maybe over a couple of years, just to give stakeholders an assurance and a good feeling about the fact that it's going to change. It would have looked like this. It's going to look like this in the future. There isn't some huge change to our business. It's just the way in which we recognise revenue has changed due to the change in standard.
Yeah, no, indeed. And I'm sure that everyone can kind of relate to that and probably can think back into the business where this implication of these regulations is genuinely going to make a difference. So I think that's why a lot of people are talking about it and why we have this 3-part series around that. So thanks very much for that case study, Nigel, and it's great that you're back in. So what I'd like to do now, I know we talked around what are the changes that are coming and what is it, but I really want to just maybe start to think about what are the challenges that these effective organisations need to have. And Nigel, from your perspective, and obviously, do you think you can maybe pull up some of the challenges that you see?
Yeah, I mean, to meet the standard as we go forward, when it's in, there's going to need to be significant changes around the transactional systems, around the finance systems. In other words, you're going to have to be able to deal with how the obligations are or when the obligations are met and the value of the obligations, and be able to invoice correctly against the standard. So there's going to be some significant changes within the transactional processing and processes that take place within the organisation. It's going to affect reporting because the numbers are going to look significantly different once you do this, and we've talked a bit about restatement. And say the processes, it's going to be more complicated to manage that order, obligation, value, transaction, all the way through the duration of the contract. And say the stakeholder perception there is that you need to make it clear to stakeholders what the changes will be, what they will look like, and that's why restatement is good. Because the last thing you want is a major shock to your stakeholders, because that's going to affect your share price, guaranteed.
Perfect. And Melanie, from your perspective, then obviously what Nigel's gone through.
Oh, I mean, Nigel's absolutely right. I mean, it's far-reaching. It has a profound effect. It's not just the contracts. It's going to affect, obviously commissions, bonusing, budgeting, all that.
Yeah, indeed. And I think it's a really interesting one here that both Nigel from a vendor perspective and Mel from an office and finance perspective are basically saying the same challenges, right? And we're all seeing the same challenges. And Melanie, you picked up really great on around the commissions, bonuses. It's going to be areas that we genuinely hadn't thought about that will have a profound impact and also a massive potential disruption, as well as there's going to be loads of internal concerns across the business. I think what's key here is that any business that needs to embark on this needs to think about, well, what do we do and what is our plan of attack? Who do we go for advice? Do we seek some professional advice either from an organisation such as ourselves or from a vendor or maybe internally or maybe an audit organisation? I think what's key here is that there's some profound changes that are happening, and and I think that those effective organisations have been the points have been put out very nicely. So Mel, then we're coming towards the end of the questions then. So we've talked around the changes, all of that bit. So from your perspective and from a finance perspective, What should businesses be doing to prepare for the legislation changes for IFRS 15 and ASC 606?
Well, I mean, there's a number of things. I mean, obviously the first thing would be to review all the contracts and how they are affected, and if they are. As a company, you're going to have to think about identifying all the important accounting and tax issues that this raises, resolve areas that will require interpretation or judgment, disclosures, and what that effect has on the company, and evaluate controls, processes, and systems affected. So, it does have a far-reaching.
And I think it's also key that they've got, someone that can understand the legislation changes, right?
Oh, I mean, in some organisations, you'd be best appointing a key person to be a champion to IFRS 15, or make sure the finance department is fully up to speed.
And Nigel, from your perspective, and obviously hearing what Melanie's just gone through, you care to share a few bits from yourself?
Yeah, sure. I mean, I think the first point is you have to be clear and set your policies. What are you going to do? What are your policies? Because that's the point at which you start to then work out your current processes and procedures. How are they going to change? And then how are you going to change your systems to support those changes? What do you need to do to workflows, to the way in which you do stuff to make sure that you can actually meet those new policies? But I think the policies is the first point, because that's the starting point that affects everything you do. For some organisations, this is going to mean a significant change to their transactional systems. To the way in which they process orders, they process invoices. We've talked about commissions. Just take a simple thing like you're using a current budgeting and planning system that's driver based. So you put in various parameters about what you're going to sell and so on, and it calculates what the revenue will be going out into the future. Those drivers are going to change. If you have delivery of product and service over a period of time and so on, then you're going to have to change. That's those sort of fundamental things. Otherwise, when you run your budget's not going to be correct. And certainly, I mean, as you'd expect, we would say, then there are a whole bunch of cloud tools out there that can help you do that and help you do that quickly, without going through the infrastructure, purchase, installation, management, and so on. Maybe you've got to look at how you get this done, because we've got a relatively short period of time to run up to do this, and say for some organisations a significant amount of work to do.
Yeah, no, I think you're absolutely right there, and I think the summary point there is very much a case of don't wait. If I was to advise an organisation and offer some advice, apart from everything that we've done, it is a case of look, don't wait for those guidelines to be mandatory, because it'll probably be too late then, because there's a huge potential amount of work that needs to happen.
Yeah, and I think the other thing here, Jordan, is this probably the place. I think you start in parallel, but real focus on restatement, because it's going to take you a while to get your transactional systems up and running. But what you don't want to do is wait to the last minute to inform stakeholders of what your accounts are going to look like under the new regulation. You really need to be informing them, telling them, reassuring them as early as possible. And I know that from our experience with IFRS. The companies that did that early got their stakeholders on board, got them to understand what the implications were to their numbers of the new regulations. There was a lot more comfort. There was, their share prices didn't take a hit.
Yeah, no, I think you're absolutely perfect, and that tees up quite nicely onto what's coming next in the series, really. So I just want to say, so for today's topic, we are almost close on time, so I want to wrap it up now. I just want to say, Nigel, I really appreciate you being part of today's session, the slight technical difficulty that we had. Melanie, likewise, I really appreciate that. So going forward then, as Nigel very nicely teed up around the restatement piece, on the 5th of April we are going to be doing a focused kind of deep dive into the restatement side of the legislation and guidelines, and we've actually used Oracle Planning and Budgeting Cloud Service as a way in which we can address the restatement piece. So I'll be joined by one of my colleagues who's been spearheading this from the Enterprise Performance Management team over at Inoapps, and we're going to really be talking through that in a little bit more detail around that. And then further on the 26th of April, we're going to be looking into the revenue management side of things and the actual cloud tool from Oracle for revenue management, which we'll do from today going forward. And that ties up quite nicely with Nigel's point around, using cloud tools and able to help facilitate this legislation change. So there are no questions, which is excellent, and we are just a couple of minutes ahead of time. As always, feedback's really important on these, and like I say, this is the first of a three-part series. If you've got any questions, please feel free to email myself. My details are on the screen. I'll pass them to Nigel and Melanie. But other than that, I'd like to say thank you very much for my two guests, Nigel and Melanie.
Thank you very much, Jordan.
Thank you.
And thank you very much to everyone else for attending. Thank you.